Always wondered myself, why do we have to hear this every night, what the stock market is doing?
70 record closing highs so far.
Hello and welcome to our new video. Before starting, click that like button on your screens and don't forget to press the subscribe button and bell icon, which will notify you whenever we upload new videos. So today we're going to talk about the controversial S&P stocks that could be worth buying. But first, what is S&P 500? For the people who don't know what that is, don't worry, we're here to tell you everything about it. The S&P 500 is a stock market index that tracks the performance of about 500 US corporations. It covers corporations from 11 industries to provide a picture of the stock market's and economy's health in the United States. So, what are the companies that make up the S&P 500? Companies must meet certain requirements in order to be included in the index. Companies must, among other things, number 5, have positive as reported earnings in the most recent quarter, as well as during the last 4 quarters combined. Number 4, be listed on a US exchange that qualifies. REITs or real estate investment trusts are eligible for inclusion. Number 3, assume the form of a corporation and issue common stock. Number 2, be based in the United States. Number 1, have a market capitalization of at least $8.2 billion, which refers to the total value of the company's outstanding shares. Only the country's largest and most stable firms can be included in the S&P 500 as a result of this criterion. This list is re-evaluated and updated on a quarterly basis. But is it possible to own stock in the S&P 500 index? The S&P 500 is a collection of firms, sometimes known as an index, rather than a single corporation. So, while you can't buy S&P 500 stock, you can buy S&P 500 index shares. This is, in fact, one of the most effective strategies for new investors to get their feet wet in the stock market. Some of the most popular S&P 500 index funds are Vanguard 500 Index Investors Shares, Fidelity 500 Index Fund, Schwab S&P 500 Index Fund, T. Rowe Price Equity Index 500 Fund. Okay, but what does the S&P 500 index really represent? The S&P 500 index measures the value of the company's shares by tracking the market capitalization of the roughly 500 companies that make up the index. The market cap of a corporation is derived by multiplying the number of outstanding stock shares by the current stock price. So, if a corporation has 2 million shares in circulation and the current share price is $5, the market capitalization is $10 million. In layman's terms, the company is worth $10 million. The value of the S&P 500 is derived using each company's market cap, adjusted to take into account only the number of publicly traded shares. If we total up the market capitalizations of all the companies in the index, we can estimate that the S&P 500 was valued at $24.47 trillion in February 2020. Whoa! Each firm in the S&P 500, on the other hand, is assigned a specific weighting, which is calculated by dividing the company's unique market cap by the overall market cap of the S&P 500. As a result, companies with bigger market caps are given a higher weighting than companies with smaller market caps. Some of the most heavily weighted stocks in the S&P 500 right now are Apple Incorporated, Microsoft Corporation, Amazon.com Incorporated, Facebook Incorporated Class A, Alphabet Incorporated Class A, Alphabet Incorporated Class C, Berkshire Hathaway Incorporated Class B, JP Morgan Chase and Company, Tesla Incorporated, Nvidia Corporation. Have you heard of these before? Do you own any of these stocks? In the comment section down below, let us know. But why are the weightings assigned? To provide the most accurate picture of the stock market's health. This is significant because a 10% increase or decrease in Microsoft stock may result in a gain or loss of hundreds of billions of dollars. In comparison, the Gap, a clothes company, is near the bottom of the list. Its stock might gain or lose a couple of $100 million if it rises or falls 10%. In this scenario, Microsoft's price changes result in a significantly higher economic upheaval than the Gap's. The overall market cap of the S&P 500 index is divided by a proprietary divisor to get the number we see on the ticker. Each movement in the share prices of S&P 500 firms has an impact on the index's value throughout the day, while those towards the top of the list have a far higher impact than those near the bottom. Then you must be thinking, what is the S&P 500's average return? Without adjusting for inflation, the average yearly total return of the S&P 500, which includes dividends, has been around 10% for nearly a century. Keep in mind, however, that this does not guarantee a yearly return of 10% on an S&P 500 index fund. The S&P 500, for example, closed 2008 with a startling 37% loss. The following year, it increased by 26%. A long-term investing strategy and a willingness to ride out market volatility are required to earn a 10% average annual total return. Now the question comes, what differences do the Dow Jones Industrial Average and the Standard & Poor's 500 index have? Another stock market index that comprises large, established corporations is the DGIA, or simply the Dow. There are, however, a few crucial distinctions. Number 3, the Dow Jones Industrial Average is only made up of 30 firms, each of which is a market leader in its field. Number 2, the Dow is weighted based on each company's share price rather than its market capitalization. Thus, companies with higher share prices are given more weight. The index is generated by summing the share prices of all 30 businesses, adjusting for weight, and then dividing by the Dow divisor, a predefined constant. Number 1, in comparison to the S&P 500, which has 11 sectors, the Dow has 9. Companies that are considered to be the country's healthiest corporations are represented in both the S&P 500 and the Dow. Now, finally, coming to controversial S&P 500 stocks. Stock market controversies normally indicate risk, high volatility, and the possibility of big losses, but they can also be an opportunity for investors with strong constitutions. A tried and true technique for finding value is to look where others are afraid to go. The bull-bear spread is a simple way to gauge how strongly Wall Street differs on a stock. The width of the gap between the street's greatest and the lowest stock price targets relative to the present price provides an apples-to-apples metric. Consider Tesla, a perennially divisive stock. Piper Sandler analyst Alex Potter's top target price for Tesla shares was $1,200 per share. This aim was over 100% higher than previous levels, valuing Tesla at around $1 trillion. GLI research analyst Gordon Johnson has set a modest target of $67 per share, valuing the company at around $60 billion, equal to Ford Motor Company. The gap between the two calls is more than $1,100 per share, or approximately 185% of the stock's latest price of $610. For equities in the S&P 500, the average bull-bear spread is around 50% of their current values. Buying controversy was a brilliant idea a year ago. The 24 most contentious stocks in the S&P 500 as of June 2020 have returned approximately 105% on average in the past year. That's nearly double the average return of an S&P 500 stock. Every single one of the 24 stocks is up. Last year, uncertainty over how the pandemic would play out sparked a lot of debate. The average bull-bear spread for most contentious stocks, including cruise lines, airlines, oil companies, and retailers, more than 170% of current stock values were averaged. In 2021, there will be less controversy. The average bull-bear spread for the 24 most controversial S&P 500 stocks in 2021 is roughly 120%, and the names are most diverse. Tesla, Sherwin-Williams, Dish Network, Viacom CBS, Penn National Gaming, Under Armour, Advanced Micro Devices, Western Digital, ResMed, Freeport McMoran, Discovery, Micron Technology, American Airlines, Hans Brands, Netflix, Nove, L Brands, Insight, Colgate-Palmolive, Carnival, General Electric, Schlumberger, Twitter, and Ball are companies that qualified. Some of the differences in viewpoints this year are understandable. Tesla, for example, has sparked debate on Wall Street about whether it should be valued so much higher than other automakers. Airlines are still reeling from the effects of COVID-19. Analysts disagree on how well Netflix will be able to compete with growing streaming video competition. Some debates are difficult to comprehend. For instance, why Wall Street dividend over paint and toothpaste and cans, although each stock has widespread. This lack of clarity leads to an important point. Stock screens can help you find new ideas, but they aren't a complete investment thesis. All businesses must be judged on their own capabilities. The debate over the 2020 list has cooled down as the economy improves, boosting the prospects of businesses across the board. As opinions have converged and company prices have climbed, the average bull-bear spread has shrunk to below 100% of the current stock price. If the economy continues to improve, the present list of contentious stocks could be even longer by 2022. Let us know your thoughts on the stock market in the comment section down below, and tell us what old stocks you have and are going to buy in 2021. Share all your stock market stories with us and keep coming back for all such interesting videos. Goodbye until we meet in the next video.